I consistently day trade using futures for just 60 minutes every morning, and I'm able to consistently find profitable trades. In this video, I'm gonna go through the whole laundry list of things that you need to know and understand about futures and how they work. I'm gonna just explain to you the basics of how futures work, how they're priced differently compared to other assets, why they're actually just better than other assets if you ask me. I've traded everything and I find futures to be the best. What's margin, how it works, what's overnight margin, intraday margin, how they're priced, what is the best place to actually trade futures, and we'll go through a lot of other things and even some tax advantages of trading futures over other assets. And so we're gonna start with the basics and slowly build you up. So after the end of this video, you will be able to have a trading platform and understand how futures work and to be able to start executing a trading strategy with it. Now, futures work differently than stocks in many ways, but once you understand them, it's very simple, just like trading a normal stock. If you buy it and it goes up, you make money. And if it goes down, you lose money. For example, though, the big difference is when you buy, let's say, one share of Apple, you can hold that share as long as you want. You own a piece of that company and it will never expire unless the company goes bankrupt or is taken private. With futures, you aren't actually buying part of, let's say, a company like Apple. You are buying a contract agreement that's value is based on the market it's connected with. So for example, let's say you buy one futures contract in the oil market. The contract's value will go up when the oil price increases, and it will go down if the price decreases. The exact same way a share price of Apple would go up or down. So when it comes to the practicality of actually trading this, there's basically no difference. But the only thing is the futures contracts expire unlike shares. The length of a futures contract can depend on what market you're actually trading, but generally it's 1 month or 3 months. This is the one reason why futures are shorter term trading asset. It's not something you hold for a long term. Most people like me day trade using them. That's where the real advantage comes into play. The trading platform I'm using is called NinjaTrader. I've been using them for over 5 years now. And one of the nice things is they don't charge you to practice with live trading data right away, which most platforms do. You can check it out using the link in the description of this video or using this QR code. Now, technically, when you buy an oil futures contract, you are buying the ability to buy 1,000 barrels of oil at a certain price. That's the nuts and bolts behind it. But in reality, you're never gonna do that. You are just using this contract to get leverage of 1,000 barrels of oil. Because this contract actually costs a fraction of the purchase price of 1,000 barrels of oil. But you get the value increase or decrease of those 1,000 barrels of oil. It's the exact same thing as buying a house with a loan. You only put up the down payment for the house, let's say $100,000 on $1 million house, but you get the increase or decrease of the $1 million value of the house. But you're only putting up a fraction of the total value in the down payment. Now, in the trading world, that down payment on the house is not called a down payment, it's called a margin requirement. Just think of it like the collateral that you need to put up for one futures contract of, let's say, oil. For example, now, if we buy one futures contract of the S&P 500 futures, which is a different futures market, this will take about $500 worth of margin. Your account will have $500 taken away as collateral. But when you sell the contract back, you get the $500 worth of margin back. Now, this isn't taking into the account the profit or loss that you made on the specific trade you took. So when you see the price of the S&P 500 futures trading at, let's say, 6,000, it doesn't actually cost you $6,000 to buy one futures contract compared to, when you buy shares. It's actually based on the margin requirement at the time. Now, the market requirement will differ from asset to asset, like oil futures to wheat futures, or from brokerage to brokerage, and time of day. And so let me break down to you each one of those categories. First off, you have what is called intraday and overnight margin. So for example, the US stock market is only open during the New York trading session, which is 9:30 a.m. Eastern Standard Time till 4 p.m. Eastern Standard Time. This is the only time of day that you can trade stocks that are in that market. But futures, on the other hand, are open almost 24 hours a day, 7 days a week. They technically close for a short amount of time after the New York session closes and over the weekend, but this is how the intraday and overnight margin difference is made. If you're trading, let's say, the S&P 500 futures during the New York session, when all other stocks are open, in that 9:30 to 4 o'clock window, you only are required to put up the intraday margin, which is generally extremely low, compared to the overnight margin, which is any time the New York market is closed. So for the S&P 500 futures and really any US-based futures, it's gonna cost you a lot more to trade outside of that stock market open window. Now, these margin requirements can change based on brokerage. Some of the brokerage have the more normal margin requirements, which can be roughly 5,000 to 7,000 for the intraday. But other ones like NinjaTrader, which is the one I use, can have low margin requirements for, let's say, the S&P 500 futures. One contract can be $500 worth of margin, which is tiny for how much leverage and potential and profit that it gives you. But for almost all the platforms, the overnight margin is never reduced, which is generally double the intraday margin, or around 15,000 for the S&P 500 futures. Now, these are the normal margin numbers. This can actually change when market volatility goes up. Because when the market goes crazy, brokerages will see that there is more risk, and so they'll ask for more collateral, basically. So for example, in the COVID 2020 market crash, the margin requirements were double or triple at times. But it only happens very rarely in extreme times like this. And so it doesn't need to be something that you're super aware of. And generally, you should have enough money in your account to cover the change. Now, another minor difference between futures contracts is you have ones like oil where you're gaining control over a physical asset. And if you held that physical asset contract to expiration and used it, you would get barrels of oil. On other ones like the S&P 500 futures or NASDAQ futures, they aren't actually based on a physical product. It's actually based on the index that it follows. So these ones are just settled in cash. But if you're day trading or even just holding them over a couple of nights, you don't need to be worried about having to deal with settling the contracts, because it's basically never happens. I've never had this happen to me because I always close them out, or what we'll talk about in a minute is roll them over to the next expiration. You would actually have to hold it into the last week of expiration and hold it probably through the date of it expiring for that to have to happen. But the brokerages and platforms will usually just close you out of the trade as well before you have to do something like that, just because it's a nightmare on their end as well. And I'm sure you don't want to have 1,000 barrels of oil showing up at your front door. And whenever it really gets close to that date, you always trade the new contract anyway. You'll even do it a couple weeks beforehand. And what this is called is, it's called a rollover. And on NinjaTrader and other platforms, you generally don't have to worry about it. The system will either update or send you a message that pops up and tells you to roll over to the next contract. Generally, I always do it a week before, because that's most of the time that I've noticed is when the volume picks up on the next contract anyway. And you always want to be trading the contract with the most volume. And all this means is, like in NinjaTrader, you are changing the ticker symbol, which is technically the contract expiration, to the next one. So to walk you through what this looks like, the S&P 500 futures expires every 3 months, and it's always the same month. Essentially, it starts at the new year and it does it every quarter of the year. And the expiration week will always be on the Friday of the third week of that expiration month. So if you have an expiration of, let's say, 3/25, this means it's the third month of the year 2024. And then we'll always default to it expiring the third Friday of the month. And all you need to do is, it depends on the platform, but at least on NinjaTrader, you'll generally just click the rollover button, but you can also just change in the ticker to just saying 6/25. 24, because all you're changing is you're just moving over to the next month. Now, some platforms will actually just have letters for the month instead. You can see right here, this is what the letter corresponds with the month, and it will always be the same for every futures contract, no matter what you're trading. But remember, some will do it every 3 months and some will do it every month. Now, when it comes to trading, that $500 worth of margin for one S&P 500 futures contract is still massive for a small account. And so if you're wanting to start with an account of, let's say, $500 or $1,000, what you can do is you can trade what is called the micro futures. All the main futures contracts have them, and they're essentially 1/10 of the size of the normal contract size. So for the S&P 500 futures, which are normally $500 margin to purchase, the micro version is only $50. But also the price movement is 1/10 of the size as well. So your trades are gonna be smaller, but what this does is it allows you, and it's a super simple way to start and grow your small account. I did the exact same thing with my account. I started trading the S&P 500 futures with micro futures, risking $50 to $100 per trade. And then I slowly traded, growing that account, and I increased that trading size more and more. And then I eventually switched to the normal future size of the S&P 500 futures when my account was big enough. Now, the other important thing about futures is understanding how the movement in price relates to dollar change in your trade. For shares, it's super simple. Because their share value is based off of a dollar value, if your share of Apple goes up $1, you make $1. Its value is based on the dollar change. Now with futures, it's completely different. First, the price movement isn't based on money. So if you're looking at the S&P 500 futures and you have one S&P 500 contract that goes from, let's say, 6,000 to 6,001, then that doesn't mean your contract value goes up $1. It actually goes up $50. And this is called 1 point. The movement from 5,000 to 5,001 is called 1 point. Think of it just as a numerical change of 1. Now going back to shares, the smallest amount they can move is 1 penny, but that isn't the smallest amount the S&P 500 futures move. The smallest amount of movement is 0.25, which is called 1 tick. It's 1/4 of a point, so it's valued at $12.50. Now this point value and tick size is different for each futures market. So for the ES futures, which is the S&P 500, its smallest tick size is 0.25, and that's valued at $12.50, and the point value is $50. But if we go look at oil, the smallest amount of movement it can do is 0.01, or almost you could say like a penny, and that's called a tick for oil. That's the smallest movement it can do, and that's valued at $10 a tick. So 1 point or one numerical movement in oil is valued at $1,000. But there's way more ticks and movements in that 1 point of movement. And so if you look at the two markets, the amount that they move is drastically different. Oil moves in a lot smaller increments, so the sizing of the contract value with $1,000 for a point makes sense because it's generally only moving between $60 to $80. And the S&P 500 futures, which is valued between 5,000 and 6,000, has a lot more point movement in between there. Now, one thing to be aware of is trading futures, you are over leveraging yourself. For the ES futures contract, only putting up $500 worth of margin isn't your max loss. Technically, you own one contract of the ES futures market, and if the market suddenly crashes, you could lose more than your account or that $500. Now this almost never happens. I've never had it happen to me over the 5+ years I've been trading futures. And there's a couple ways you can protect yourself to make sure this doesn't ever happen. The first way is always have a stop loss in place no matter what. Never move it farther away. First off, increasing your potential risk once you're in a trade, because if the market opens and goes against you really quickly, this stop loss will get you out of the trade as fast as possible, not allowing you to lose more than you were planning. Now you can get something called slippage, where the market's moving so fast, even a market order won't get filled at the exact price. This doesn't really happen that often, and in the end, it's not actually that much money that it will slip. You might lose a bit more than you wanted to, but it won't be a crazy amount. The other way for this to happen, and let me show you on a chart real quick, is if you traded and held through the futures market closing and then opening. And so essentially what that would look like is if you entered in, let's say a buy here, expecting the market's gonna go up, and the futures market closes for an hour after the trading day every day. And so you can see here, if you entered in a trade here, the market closed right at this price and then opened all the way down here. And if your stop loss of, let's say, risking $500 was right here, and let's say your account, is $1,000 and you're only planning to risk a couple hundred here, well, the best price you could have done was all the way down here, which would have been a couple $1,000s worth of loss. And so that's how you could have had an over-exaggerated amount of loss that could theoretically blow your account up. So that's the biggest thing that I would do, is never hold futures into an overnight close, or even over into the weekend when it closes. Basically, when it closes and opens again, that's your big window for having an extreme loss that you can't get out of. And also, this happens a lot because news or, stock earnings will come out right after the market closes. And so when it opens again, and let's say Apple comes out with a really bad earnings report, because Apple's a big part of, let's say, the S&P 500 futures, or if you're trading the NASDAQ futures, it'll make a big drop and a gap like that we saw in the futures contract that you're trading, and you'll take a massive loss. Lastly, the only fees that come with trading futures is generally some kind of routing fee, and then the commissions that the trading brokerage you use. Generally, the routing or trading fees are fixed and will be same across the board, and then futures commissions are based on the brokerage that you're using. But because there's so many big platforms out there and they're all super competitive on the commissions, you're not really gonna find much of a difference throughout them. There's also no interest or fees with the margin that you use. That's for different types of margin accounts, generally trading like stocks on margin. Also, don't get confused with other types of margin in trading and investing that can have interest rates on the margin that you use. That's when you're essentially taking a loan out. For this, the margin is more of, again, think of that like collateral or down payment you're using. And so really cool about futures is the tax benefits that comes with it. Now, I mainly switched to futures because of the simplicity. It's exactly like trading stocks, and it's not complicated like options, but it gives you the leverage that options allow. So it's kind of the best of both worlds. You buy it, it goes up, you make money, and you can do it with a small account and get super crazy leverage. And then as well, on the back end, when it comes to tax season, there's a really cool rule that is applied to it. Now, of course, I'm not a tax professional. This is kind of just what I know from doing it myself and and what's out there just based on the internet. And so when it comes down to it, 60% of your profits is in a way lower tax bracket, and then 40% is in your normal tax bracket, what you make in that year as a normal, like let's say W-2. And so what this allows you to do is, even though you're day trading, it counts in a way as a long-term investment or asset. And you essentially just get to keep more of the money you made. Compared to everything else, you have to hold it for a whole year before it becomes in that long-term capital gains category. And so now let's go to NinjaTrader here, and I'm gonna practically show you some of how this looks like on a real chart. And so this is looking at the S&P 500 futures, the ES futures. We're looking at the main contract, not the micro smaller version. This is the full contract. And you can see over here on the left side this is the price movement, and it's going up in 0.25 increments. Sometimes it might jump a little bit more because the market's moving pretty quickly right now, but generally it'll move up by 0.25. And then if I just click right here, buy market at one contract, you can see that the dollar amount is going up or down in 12.25 increments. And if it moves up 1 point in my favor, that'll be about $50. And so you can see, we're looking at a 1 minute chart right here, the dollar movement per price is very, very large. We're trading one contract here, and you can see over this one small candlestick, I'm already up like $200. And so you can imagine if the market just moves up right here, that's probably like $1,000. And this move right here that took about 25 minutes with one futures contract would have been probably like $2,000. And so you can see the leverage of that money comes into play massively. You know, this costed me $500 worth of margin, and you can see that I'm already basically up $500. And so the leverage there that you can get on a tiny account to potentially make a huge amount is really, really big with these contracts. But again, you can see on the flip side, that $500 I was up has all of a sudden seemed to start to evaporate, right? And so again, leverage can work against you or for you. And so that's where you want to then go into. If I then just, you know, this is just a demo account, I'm not gonna just be goofing around on real money here. If we go into the micro futures, you can see it looks the exact same chart, but if I buy one contract now, it's 1/10 of the size. It's going up or down $1.25. And so this is the exact same thing for everything in terms of if you jump into a micro futures contract, it allows you to now start with a super small account, and these movements for a small account are a lot more manageable, you know, instead of risking, you know, $500 for a small swing, which can seem huge. I could put, you know, enter in here and put my stop loss down here, and I could be risking $20. And I could, you know, my target could be $30. And so this is how you can start with a really, really small account and then slowly scale, because then of course to scale up, it's super easy to say, well, instead of buying one contract, I now want to buy 2 contracts. And you know, see here, this number 2 means how many contracts I have. And now it's going up by, you know, $2.50 instead of $1.25 per tick because I have 2 contracts instead of 1. And so you can, you know, that's how it's allowed, you can easily increment your size as you go up. And so you can see this movement here is, you know, now I can target maybe $200 worth of profit for, you know, a $50 or $75 risk as you slowly increase your size when you're becoming profitable. And so the best way that I have actually found to trade futures is actually looking for reversals on a 1-minute chart. You can trade futures on a 1 minute, a 5 minute, or even an hourly chart. Again, it's all about trying not to hold through overnight and mainly just sticking to day trading. That's really where the power comes in. You can hold something for a couple of days, but again, it opens you up to that risk of having, you know, those large drops from, you know, the market closing and then opening up again with news in between. But what I've found to be super powerful is literally in the first 60 minutes every morning, I just watch the US stock market open. That's when it's super volatile, has a lot of potential swings like this. And you can see this swing right here in the last, you know, what we were just looking at, that could be a couple $1,000s, right? If you're trading large size. And so you can easily make a strong amount of money trading once you become profitable with this strategy in literally just 60 minutes in a day. It's what I have traded for a while now, and it's literally all I do. And so to walk you through that now, what I do every morning, I literally just come in, I look for key areas of, you know, support and resistance. And you can see here, the market bounced right here. And so that's why I'm kind of thinking, okay, well, if it comes down here again, I want to see if we'll bounce again. And so that's kind of the first thing that I always look for in this strategy is looking for the market to bounce at a key level. You don't want to just be randomly thinking, okay, well, it'll go here, it'll go there. You know, that's when you start to become reactionary to the market, and you want to actually have a plan and wait for the market to fit that plan. I have realized that over time that that's really the way to become profitable. And the other part of that is just find one strategy and one pattern that works. You don't need to find 10 different strategies and be trying to capture, you know, every move in the market, because like you just saw, when it comes to the sizing and scaling, these numbers in a way can become infinitely huge, right? You could be literally risking $10,000 on a trade and make, you know, $40,000 in 20 minutes. Now that seems mind-blowing, because, you know, when I first started, I was risking literally like $25, $50. But now in this trade right here, I'm risking something like $500. And you'll see the potential can go really fast once you kind of get this in play. And so the next thing I like to look for is, you can see the market came down here to this level and it actually broke this downtrend. So that's kind of the second thing I like to look for. When you're looking for reversals, you need to make sure that the downtrend is broken. And so what I've done here is I've kind of confirmed that after this trend was broken. And so it's starting to show some strength, some bullish candlesticks. And I like that for getting in on a trade, betting that the market is going to go higher. Now, kind of the last couple thing I like to look for is I want to see the market kind of start to show kind of a bottoming pattern. Right here, it's basically making higher highs. And so I like this, as this candlestick was a really kind of a big bearish candlestick attempting the market to go lower, and it failed here based on these candlesticks. And so I like the idea of saying, hey, I want to get in long above this candlestick right here, betting that the market is going to go higher. And so I put what is called a buy stop order above it. If the price of the market touches this price, put in a market order. I don't care where you fill me at, just get me in the market. And most of the time you can see it literally just filled at that exact price. But sometimes it can, fill you right here because the market can move pretty fast. But that is the order I like to enter in on most of the time. And you can use a buy limit order that'll get you in below or exactly at that price. But the problem with that is, well, for this example right here, well, the market kind of took off here and you would have felt a lot of FOMO, and because you would have missed out on the trade, and you would have had to wait for and hope that the market comes back down and fills you at that price. And so you can see here quickly, just over a couple candlesticks, I'm already up $1,000 on this trade, risking, I think $500 or $600. And so this is where the power comes into play, is I'm trading 4 oil futures contracts here. And you can see it's moving in that 0.01 increment, that penny size, compared to the S&P 500 futures that we're just looking at was actually moving in that quarter of a point size, that 0.25. But you can see here clearly that the money is a lot more. And so for me, my strategy is I like to kind of get in when I see, basically you can easily see here is there's a lot of momentum here. It started to slow down by essentially just seeing that the market kind of started chop here. And then I look for a few key factors to jump in and catch the momentum to the other side. And so I moved my stop here to break even. And then as it starts to kind of get pretty accelerated here, I like to use kind of the idea that, hey, okay, I'm gonna give it a little bit of wiggle room, but I am gonna move my stop up if it pulls back, because I'm up about $2,000, and you wanna let this thing run if it's gonna run, but you also, you can see like just as it pulled back right here, it can reverse very, very quickly too. And so that's where I really look to, manage my trades. But again, that's come with a lot of practice and experience trading this. My target here, you can see now that we're getting up to here, you can see we're kind of in a support level that I've drawn from previously in the chart. And that's where I'm gonna expect things to slow down. And so you can see I've moved my stop loss up here. It's, we're up a lot more money now. And this is where kind of the power comes into play of using technical analysis with futures, is you have that leverage and you have that ease of getting in and out of the market, but you also have the simplicity of, you're not having to deal with the complexity of options and other factors that come into play with other assets. And so just to close this out, I'm not gonna go into my strategy too much here. I have a lot more videos on that, but I pretty much get knocked out right there. So no matter how you're planning to start trading, even if you're planning to start prop firm trading, I highly recommend demo trading first. The fees for prop firm trading can be really expensive if you're not able to be consistently profitable right away. That's why it's smart to use NinjaTrader first, and once you're more comfortable, then switch over to prop firms. Again, you can check out NinjaTrader in the description or using this QR code. And if you want to just learn more about my strategy I've been talking about here, check out this video right here.